Holy mackerel. Remember our cup and handle here? And the breakout? This can keep going because, I can point to trend lines that go a lot higher. Bang. 2028. Remember the 10-year cycle? Bad things don't happen until the 8th, 9th, 7th, 8th, 9th year, whatever. S&P 9,000. I know it sounds completely stupid, especially with market cap at 191% to GDP. And I don't want to outstretch targets or anything like that. I'm just looking at the theoretical chart construct. So one of those things in the cumulative advance decline has to be right. It's either a complete fake out, an overstatement, or we're at the beginning of something much larger yet to happen.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, the markets are back to all-time highs, and the central banks around the world are either increasingly talking of interest rate cuts or actually making them. Will that take asset prices even higher from here? Are we in a new golden era for stocks? To find out what the technicals are telling us, as well as to dig into the macro side as well, we're fortunate to speak today with Sven Henrich, technical analyst and publisher of NorthmanTrader.com. Sven, it's great to see you again. Thanks so much for joining us today, all the way from London.
Thanks for having me, Adam. Good to be with you again. By the way, the background is completely fictional. We have absolutely no sun over here. It's just
Okay.
It's not happening this year.
I guess you need AI to enjoy sun in the UK these days, huh?
No, I need an airport and a plane. That's what I need.
Okay. Well, look, number of questions here for you. I know you prepared a number of slides too, so we're going to get into those in just a minute. I will run the clip of this in a little bit, but I do just want to start by giving you props, Sven, because the last time you were on this program back in early February, you were looking at a chart pattern that you said, if this plays out, it could take the S&P all the way up to 5,400. And, ding, 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 we just rang that 5,400 bell on the S&P yesterday. So kudos to you for the accuracy of your TA there. We'll get into the reasons why you thought that might happen and what you think is going to happen from here. But before we get into all that, let me just ask the question I like to kick these discussions with you off with, which is, what's your current assessment of the global economy and the financial markets?
Hi, Adam. Thanks for the kind intro. The assessment of financial markets and the economy, and perhaps even more broadly, I think, as I look at the world, can increasingly be summarized with one word, which is bifurcation. We see bifurcation in markets. We see bifurcation in the economy. We see it in the society at large. We see it now in monetary policy. We see it obviously in politics and social developments. It's increasingly a freak show, I have to say, in some way, because we have never seen anything like that. Look, I've been around the block a little bit. I've seen the extremes and various bubbles and what have you. But this development that we see now is so unprecedented. I think that everybody kind of has to step back and first acknowledge that it exists. And I'll share some charts with you on that. So just we're all on the same page. And second, and of course, the more important question is, what does it mean? Because you can be open to all kinds of different interpretations for that. You mentioned at the outset the 5,400 target. I'm tickled pink that has come to fruition. Because we've been looking at it since October, pointed out in January with you in February. So, you always think about free will of markets, but then you look at big technical structures and then they ultimately tend to get there. And then when you get to a big target level, you kind of want to reassess, is that now a point where things may change? Maybe we get some sort of rejection, a pause, or what have you. How have things developed in the lead up to a particular target? And you want to look at structures in the market itself and the economy, and of course, what's happening on the macro front to then get a sense, okay, what should be the positioning now or the strategy now? Because our strategy has been very clear from all that. We want to keep buying dips. We want to look at support levels and just keep at it until we get there. And yeah, on the way, your conviction gets challenged. There's no question about it, because you always deal with uncertainty. So, from 4,200 to 5,400, it's just been a ridiculous run, especially in that time frame. So pleased with that. But bifurcation, and this is where I'm going to also not want to sound too enthused about this 5,400 target, is because the way it came about. And I guess in the next questions we can deal into the mechanics of all that, because it's highly unusual how we got there.
Okay, so first off, let me just play the quick clip of you showing the cup and handle formation and making the prediction. So I'll just do that right now.
What we got technically objectively observe here is this pattern is played. It was a powerful breakout and it's just ripped higher. And structurally, this chart has moved a room into 5,400.
All right. Well, again, Sven, yeah, kudos to you for having the clarity of foresight to make that call. So now that we are here, yeah, why don't you tell us sort of, you said when you hit a big target, you reassess. Tell us what you take away from the journey to 5,400 and what you think is likely to happen next.
Okay, well, let's first update the chart. And I'm now armed with screen sharing, so everybody get ready. I'm armed and dangerous, so to speak. But here's the chart of the updated S&P. I mean, this cup and handle basically played beautifully when we saw this big breakout here from the fall into the beginning of the year, when we had this most ridiculous rally of, on nonstop up weeks. And back when we talked in February, I was full disclosure, I was talking about maybe we'll get some sort of correction in March per seasonal. That never happened. The correction came in April, and the seasonals were quite skewed at that point. I expected something maybe as extreme as 8%, because we had a particular levels in mind. That didn't happen. We got about a 6.2% correction in April. Very important to note, what prompted the correction was, again, this entire liquidity equation that we've been talking about, specifically Janet Yellen. She had to refill the TGA account that drained liquidity, and that was kind of the trigger that helped cause it all. But look, super clean. We got 3 tags of the weekly 20 MA. It was just, as clean as it could be. And then we just moved on back to new highs here in the last couple of months. And now this kind of push here. One thing that has been missing from my perspective all along, for like big tops, you would get like a move into the upper weekly Bollinger Band. And we just didn't have this in the entire run up, but we just got it, right? And as I mentioned, if you get to a big target, you will kind of want to assess. And one of the big red flags right now is that we have a big weekly negative divergence. By the way, as I'm outlining all my thoughts here today, I want to keep everybody totally open-minded here, because I kind of share with you my analytical process here. I can point out what could be bearish, and I'll point out what could be bullish. And it's from my perspective, a really interesting journey because of everything being so skewed, and I'll get to that, okay? But let's be very clear. From this 2020 bottom, the October 22 bottom, this little fake out here in fall of 23, the big trends have been holding up. This year, we got a new uptrend build in April, in April, and then now it's held again here in May, and here we go into a very narrowing channel. So it's kind of a red flag, if you will, because we're now in the upper weekly Bollinger Band. But I just want to note from a principal perspective, this cup and handle has now played its target. Beautiful. So technicals still work in our somewhat warped world, if you will. Okay, but now it gets interesting. Okay, I'll show you the next chart here. This is another chart of the S&P in the weekly, and this is now an area where you look at larger points of resistance and support. Okay, recently I put out a video called the Wow chart. The Wow chart talked about a long-term trend line that was resistance for years. Then during the post-COVID period, got pushed above with all this money printing, and then during the 22 bear market, kind of fell below, became a resistance again, was resistance again last year, and then we finally broke above it, and the April correction actually held it perfectly. It's fascinating to see long-term trend lines like this still show relevance in technical settings over long term. And guess what? The 5,400 move now has brought us back to another resistance line. That dates back all the way to 2000. So you could principally make the case we're now in an area of caution because it could be resistance and could set up for another corrective move. And then at the same time, keeping an open mind, we want to point out that here's also another trend line that's much higher, okay? So in terms of pivots of control, I think the summary message is, as of now, bulls have been since October 22 in complete technical control, and everything's gone their way, okay? So that's kind of just a note of principally technically what's happened on the larger structure. Now, bifurcation, because the way we're getting there is bizarre in many ways, right? I mean, we all know about the control of the big cap tech companies. And just a couple of points to highlight. I'm sure you guys have seen a chart similar to this, which just basically shows that, the S&P, 5 companies make a larger share of the S&P than ever seen before. There's just no precedence for that, not even during the bubble times. Then you can say, okay, well, this is a massive bubble again. You can argue that. But you also got to recognize that in 2000, for example, that's why I give you the counterweight argument, a lot of these valuations extensions were driven literally by fluff, right? On business models that were not yet come to fruition to support those type of valuations. It was a narrative-based bubble. This time around, we do have companies that have just an enormous earnings growth story behind it, i.e. NVIDIA, right? Because you got these big companies spending tons of money on infrastructure to build out the entire AI platform, if you will. So in that sense, it's maybe different. What may not be different is, yeah, we got all these expenses and all this infrastructure spending, but what's ultimately the revenue and earnings growth story behind it? I guess that's the undiscovered country because we don't quite know that yet. What's probably most terrifying for all of us to understand and to come to terms with is the fact that we're in this process now seeing the largest and fastest market cap expansion in history. It was only in 2018 when Apple became the first company ever to reach $1 trillion in market cap. Remember that? That was a big deal in the news. And now, just fast forward 6 years later, we got 3 companies over $3 trillion in market cap. With the combination of this is almost $10 trillion, so $9.7 trillion. Just absolutely unprecedented. Apple, I mean, just in 2 days added $400 billion in market cap. Earlier this spring, we were shocked to see Facebook and other companies add $150 billion in market cap in 1 day. Now it's accelerated to 400 billion in 2 days. And so, yeah, I think it's a fair question for anyone to ponder and say, oh my God, how is this even sustainable? And with the concentration that we see in this market, what, if anything, goes wrong with these guys? I think that's a totally legitimate question in terms of the concentration. So I just want to highlight that because of the implications of what we're seeing in the charts. So I mentioned the 5,400 target being reached in these key trend lines. Now let's look at how we're all perhaps getting a bit skewed in terms of perception, because the view is we have this just absolute fabulous bull market, right? But here's a chart, courtesy myself, kind of trying to put things together. This is a way of looking at the market without these particular components. And that is equal weight. You got the S&P and the NASDAQ on top. They're up, 16.6 and 14% respectively, right? Big. Now, if you look at the S&P on an equal weight basis and the NASDAQ on an equal weight basis, they're actually down here in the 4% range. So the overpowering aspect of this is so dominating that, yeah, it looks so fantastic, but take those 5 companies out, it's actually kind of a run-of-the-mill bull market. So when everybody says, the S&P is up so much and that means it's going to keep going up, yeah, maybe, but be aware what's underneath, what lurks beneath is perhaps not all that impressive. And the other key indices I put in here are the Dow and the small caps, so the Russell, up basically 2% on the year, and recently having gone flat actually in the last few days. So the overall market is actually not that impressive and perhaps more reflective of what's going on in the broader economy. Hence, I mentioned bifurcation in markets. We're all kind of looking through a distorted lens in trying to understand markets. And before I go into some other charts, I wanted to go back what you and I discussed in February. That was this 10-year cycle from the cynic's guide of markets, right? Because if you look at, forget the 5 and forget the distortion in the main indices, if you just look at the overall market performance, ironically, it's doing exactly what the 10-year cycle suggested. This 10-year cycle was suggestive that in the 4th year of the 10-year cycle, remember we had a 22 and a 2-year bottom. That was 2022 was the bottom. We had a rally in 2023, which is the 3rd year. And then in the 4th year, we kind of would pause and we would have moves up to flat before the big rip higher. And, again, anyone that hasn't seen the article, still my pinned tweet on Twitter, X, and you can see it there with all the kind of the historical trends. So in that sense, actually, what we're seeing is not unusual if I look at just the market in the broader context. And then it suggests the big run comes in the 5th year. And what that also says is actually there should be some sort of rotation trade coming later this year, at some point this year. I can't say when. So you have this, you're in a situation where you look at charts in the big cap tech sector that have you freak out and thinking it's this hyper bull market. But if you look at the broader markets, really not at all. It's just kind of chugging along, and so that creates an analytical challenge, I would say, because I look at the S&P, I look at the NASDAQ, I say, oh my God, they're highly overbought and at risk of a sizable correction, right? But then these other charts are not overbought. And let me highlight a couple of signal charts, Adam. Okay.
Sure.
Appreciate your patience because this is
it's great.
so incredibly important. So this week, obviously, we hit into the 5,400 area, new all-time highs. And what do we have on the signal charts? It's never seen before. I'll give you one example, a key chart, NIMO. It's one of those oversold or overbought signal charts. It kind of tells you what's going on underneath. There's not even a move to green on new all-time highs. We haven't had a single green reading since May 22nd. Red readings are associated with corrections. I mean, look at this. This was in October of last year, right? When we were dropping here into the 4,100 area, okay? This is a hallmark of a correction. This is typically what you see during corrections. And then during rallies, you see it move up to positive. But the market's been really weak all year because following that initial big rally in November, December, these positive readings were very weak. Again, reflective of how weak the market has been underneath, how unimpressive it has been. And the reason the April bottom was a buy, because they had put out a video called Signal Fire, because NYMO was just massively cooked to the downside, minus 100. And so that set up for a rally. And then it came to fruition, fair enough. But now we have another rally, and it's not even turning to green. And so this bifurcation that we've seen all year has been getting worse, is my interpretation, which means you have Apple, NVIDIA, these kind of stocks going hyper, but you have the market underneath correcting, which is a bit confounding, because that means that you actually have sneaky oversold readings in the market. So for example, if you were to see a broadening out on the market rally, a rotation, for example, this could really fly, right? Likewise, if there was a correction, it would be oversold very quickly. So these are some of the challenges that we're facing in the chart makeup as a result of the bifurcation. Another example is components of the S&P above the 50 MA. I mean, it is shockingly weak. This is today, new all-time highs, or rather yesterday, in less than 50% of S&P components above the 50 MA. It's been getting weaker and weaker and weaker from high to high to high this year. I mean, look in January, it was at 91, then it was 85, then 64, now it's 48. Really? What's that? Yeah, it just tells you how unusually the market is behaving. Here, even in 22, you got these big counter rallies still in the bear market. These things popped 75, 92. We don't have that here. It's completely different, unlike anything that we've seen in what's happening as a result of this. And this is where I come to kind of the mind blower for me. I put this out on as a video as bifurcation this week. I'll show you this chart here, and that is cumulative high lows, historically speaking. This is probably maybe the most important chart. These first 6 boxes, it goes back 20 years. These first few boxes show you the S&P in green vis-a-vis cumulative new highs, new lows in the US stock market. And as you can see, in every major bull market that we've had over the years, what happens is that line, the cumulative advance line, goes positive, it goes big, it goes along with the market. And every time we have a bear market, obviously it goes red. We had that here during the financial crisis. We had it here in 2015. We had it in 2018. We had it here in the COVID crash, obviously, and then in 2022. And then typically what happens in every one of these, when the low is in and the S&P recovers, the cumulative advance line immediately turns north. Immediately. It's a kind of broad-based market rally. And you see that every single time when that happens, even following the COVID crash, instant. And this brings me to now, because it's so bizarre. The low was in October 22, and the S&P turned north. Cumulative advance decline did not. It kept dropping. It kept dropping all year, even as the S&P rallied higher. It was not until the end of 23, it's finally starting turning. So now we have this just massive, massive divergence. And that brings us now to 2 possible conclusions, okay? The first one is to say, well, this is all fake. This bull market's never confirmed, and we're all being completely distracted by these top 5 that control so much market cap, as we showed, and control the indices and the movement of the indices. And that could imply a big reckoning to come. That's one interpretation. And the other one is that the bull market actually started here. It started turning, which could imply that we're just at the very beginning of this. And if these 4 or 5 don't correct hardly, because maybe they have that big earnings story to support the whole market equation, multiple equation, and you get into a rotation phase, maybe driven by lower rates and lower yields and soft landing and da. This could really fly. And then all of a sudden, if that's the case, I can give you a market construct that shows something completely different. And yeah, yes, we have resistance here and there, but you want a real chart?
Go for it.
Yeah, I mean, holy mackerel. Remember our cup and handle here? And the breakout? This can keep going because, I can point to trend lines that go a lot higher. Bang. 2028, remember the 10-year cycle? Bad things don't happen until the 8th, 9th, 7th, 8th, 9th year, whatever. S&P 9,000. I know it sounds completely stupid, especially with market cap at 191% to GDP. And I don't want to outstretch targets or anything like that. I'm just looking at the theoretical chart construct. So one of those things in the cumulative advance decline has to be right. It's either a complete fake out, an overstatement, or we're at the beginning of something much larger yet to happen. And we will not know the answer until later, unfortunately. That's kind of my general technical viewpoint here in terms of control. We're at key resistance. We reached a key target. It was driven by a few stocks, literally, while other indices are lagging behind. But it's also not inconsistent with a 10-year cycle. And that leaves room for upside still. As much as that may be tough to swallow. I just never seen signal charts like this, that we make new all-time highs on virtually oversold readings. Makes very little sense. So I think we just got to be very, very analytically open-minded here and how this can play.
All right. So, boy, I remember taking away from our interview back in February, Sven, that you were what I would call reluctantly bullish back then, that you didn't philosophically think that the market, deserved to be going up, but all your TA was telling you that it likely could. And so you were saying, look, until I see technical evidence to the contrary, I've got to be bullish here, whether I like it or not. As you were going through your charts before you got up to the very last unveil, I was going to ask you, hey, are you actually building a bullish case here that underneath the party of the Magnificent Five, the market, is correcting, is getting to an oversold state, and then maybe there's going to be a baton handoff at some point here where the Magnificent Five cool off a little bit, but then the rest of the market takes off. You combine that with your Dow 10-year chart, and yeah, and I guess one could take that away from it. So anyways, clearly it sounds like you're saying we're at this really interesting juncture where either the party ends, and we can talk for a minute about some of the reasons why that party could end, or, believe it or not, as loud as the music is and as drunk as the participants on the dance floor are right now, it could get a lot more raging from here. I guess, what is it? Are we just in a wait and see mode here? Is that how you're gonna play this? And is it guardedly or reluctantly bullish until and unless you see more evidence come out?
Well, as part of the journey, the way we've been playing is, when we do see support levels and confluence in particular, we want to test. We want to test the support levels. And then if they work, great. And then we kind of scale out slowly along the way until things get stupid again, which they invariably do. And then we wait for the next setup, but we'll always have kind of the finger in the pot. The guiding principle for us has been here: play this game until there's evidence of something breaking. And every time the market has an excuse to break something, it doesn't. It's always gets saved. It's very bizarre. You know, one of the things we also talked about last time, I even know the last couple of years, you know, the powers that be. You know, April, I mentioned the April correction on the heels of the TGA account filling. You know, my old running joke, you know, who shows up at the right time? I kid you not, okay? Because we saw that again in April, okay? Here she comes, Yellen concerned. We had that big spike, again, a lower high. You know, correlation is not causation, Janet Yellen once said, but I have to be honest with you, she always shows up when there's trouble. And in April, the VIX had already retreated a little bit, but there was another little spike, and literally the headline concerned. And I always put it out on Twitter as soon as the headline comes out. And what happened after she was again quoted? I mean, the VIX just got absolutely crushed again.
Mm-hmm.
And it's always associated with not necessarily the low, but it can be, but it's always somewhat imminent. It's ridiculous, right? But it's also reflection, you know, whether you want to take it as a kind of a side joke or seriously, it doesn't really matter. I mean, I just look at what happens when and where and what the counter reaction is. But if I look at the VIX, for example, through a structural long-term lens, you know, we just have to be all aware that the VIX is in a major downtrend, has been since 21, 22, and we've been making lower highs every single time. And you know, here was your April VIX spike, right? The trend line, boom, down. And we've seen those phases before. We saw it here into 2017, which was the lowest volatility year on record. We certainly saw this here up in the lead up to the global financial crisis. And you did have VIX pokes down into the single digits 10 level. I mean, we're not that far away. And you can conceivably kind of make the case that, okay, well, as long as nothing breaks out and stays broken out, this can just keep doodling into next year, into 26. You know, I can't predict that. I just want to raise awareness that that's the time we're in. I mean, it's unusual to have the VIX this low for this extended. Obviously, even here during the bull market phases, we had regular VIX spikes into the 45 area. The fact that during this big quote unquote bear market in 22, we couldn't even get to 45 is ridiculous. But it kind of shows you who is in charge and what's in control. And yeah, you always have to worry about some Volmageddon like we had in 2018. But at this point, the evidence remains that, you know, every big spike finds Yellen on the headlines and then it dies. That's unfortunately where we're at. So I'm just trying to be respectful of what's happening in these markets and when. So, you know, so as long as I don't see a break in anything, you know, at some point this will not work. I have no doubt. In fact, frankly, based on these major resistance points that are highlighted, I would think, especially given in context of the upcoming election and the uncertainty regarding, I would say, some of the economic developments, yeah, there's a shot for a 10-15% correction at some point in the third quarter. When, I can't tell. I mean, for now, the only time we've seen any sort of type of corrective activity is during liquidity hiccups. We saw it at the beginning of January when the reverse repo spiked. By the way, that also happened in April with at the end of March. So there was a little hiccup into April because of that and the refilling of the TGA account. But as long as the liquidity flow keeps running, you know, they continue to be able to drive this market. And by the way, it's no accident that when did the correction really end in April? Well, we had two things happening, right? We had, what was it? So excuse me, in May. What happened in May? We had a little hiccup in May. What happened? We had the Treasury start implementing its buyback program. And immediately, that was the day the 2-year yield peaked. It was the same day. The 2-year immediately dumped. And then what has happened at the beginning of June? Well, QT has been massively reduced. Voila, new all-time highs. That didn't take very long, did it?
You know,
So
so I've asked many times in this channel, I think we even talked about this last time you were on, is just all that matters liquidity? And, you know, I'm curious, how do you track it? I mean, do you actually, there are people out there, you know, Michael Howell of Capital Wars being one that publishes charts of how they calculate net global liquidity. Do you actually look at indicators like that?
I do. I mean, I'm trying to keep a track of the various factors. I don't have one where I can say, you know, this is kind of the aggregate of everything. And I would also say that, you know, you have different things being somewhat more relevant at sometimes vis-a-vis others. Bank reserve is a good example. I mean, reverse repo was kind of flatten out. That was a big driver with, you know, bank reserves spiking up and then moving back down. And now they kind of all stabilized. Don't forget, we're also in periods where we do have buybacks going through the system, and some periods we don't. And when they come in, you know, as they are now and have been, you know, markets tend to rip higher. And when they come out, i.e. towards earnings, things get a bit shaky. So you got to look at all these different factors in conjunction with each other, i.e. the TGA account by the Treasury being refilled, which then puts pressure on yields higher. So if you have a sense when they're going to do that, that may then end up pressuring market again, especially the more rate sensitive sectors like small caps, for example. So it's all kind of part of the market plumbing that we have to keep an eye on as well, which just makes the journey more complex. But that's why we love markets, because we constantly have to learn and adapt and see what's relevant and what's not.
What's the limiter here? You know, it's amazing that liquidity has been such a driving force during a period where the central banks who were huge liquidity providers, you know, have largely put themselves out of the game with rate hikes and QT and whatnot. But you know, now they're talking about getting back into the game, or at least moving towards getting back into the game by, you know, starting to switch to rate cuts and whatnot. And I don't think the fiscal side, now that it's gotten a taste of you know, now that politicians have gotten a taste of how nice it is to be able to spend money wantonly, are going to ratchet that down anytime soon, at least until forced to. You know, I think we would have thought that it was inflation. And while it's still sticky, you know, the Fed was quite confident yesterday, or quite optimistic yesterday, that it's getting inflation under control and still will be doing at least one rate cut this year. I mean, what do you think is going to keep them from just continuing to do this? Hey, everybody likes it.
Well, I mean, let's talk first fiscal, because yeah, we talked about that last time. This is the underlying big behemoth, fiscal impulse. In fact, just a couple of days ago, in fact, yesterday, the official deficit came out for May. Or was it April? It was just some ridiculous number, $368 billion, which was $108 billion larger than last year. Remember, last year, fiscal impulse, they ran basically a $2 trillion deficit. And the CBO just came out and says, well, you know, we thought this year was going to be a little bit less, you know, based on our forecasts in February. And now they said, well, we were wrong. It's going to be bigger again, bigger than last year. And that was what, 6.5% of GDP spending. See, this is the other bifurcation we have in analyzing the entire market complex and the economic complex. We've just never been in that environment, because this is a recession-like spending when we're not in a recession. And it's also overstating growth. and this is why this press conference yesterday was a bit of a farce by Powell. It was, and you know, it's not only me ranting about this. He got quite a bit of negative feedback across Wall Street because the projections that they put out just simply didn't make any coherent sense. I'll give you an example. You know, he comes out and, you know, they've all repeating this, how strong the labor market is, right? The labor market is strong, so we don't need to cut rates. Well, based on what? Based on just the headline numbers? Because we're still growing jobs. And even Janet Yellen said that we're creating a lot of jobs. She said that today. Well, can I pull up a chart?
Sure. Sure. I'm going to
I
predict
mean,
where you're pulling it up. Is it I could imagine a chart you'd be pulling up is that, you know, job growth is all part-time of foreign-born workers.
well, I mean, here you go. This is fully employed, okay? The corollary to part-time. It's gone negative. It's dropped significantly from the peak, obviously. And typically when that happens, you know, bad things can happen, i.e. recessions. It's these big rollovers are not new, right? This is a labor market that's perhaps flashing a warning sign. And yeah, I can make the corollary case and say, well, this is largely still driven by part-time work, multiple job holders even, right? Which can happen before recession. But if you look at the unemployment rate itself, this is where, you know, we're already at 4%, which Jay Powell yesterday characterized as low. Well, that's moved to positive, right? And these moves to positive also often tend to coincide with recessions. The biggest mind blower, though, was in context of recent reports that we've heard that the jobs growth over the last year has very likely been vastly overstated.
Mm-hmm.
To the tune, Bloomberg had a piece out to the tune of like 650,000, something like that. You know, big chunk of jobs that are not really there. And by the way, just let's be real here. A lot of the jobs growth just comes from a birth death rate model plug. In fact, the
Right.
last jobs report, 83% of the growth came from a model plug. And even Jay Powell yesterday admitted,
I caught that.
interesting enough. So on the one hand, he says, okay, well, the labor market is strong, but it may be overstated. And if it's overstated, then I'm sorry, the unemployment rate is not 4%.
Mm-hmm.
It's something higher. And yet, so he seems to be recognizing that. And then as he says that, he puts out this chart with the unemployment rate staying at 4%, not only this year, but next year and the year after. And I say, how can you be serious putting that out there? It just makes just internally consistently no sense. And if that's what you use as an excuse to keep rates higher for longer, even though he himself says, you know, there's risk of staying too high too long. Well, duh. If you ignore signals like that, and if you ignore actually the inflation report you got yesterday, which they clearly did as well, you know, we've been through this before, you and I, Adam.
And
I mean, I put this out on Twitter today, the famous, you know, Fed quotes, you know, from 2007 and 8. You know, the economy is so resilient that, yes, It always is. It's resilient until it's not. And what's been lacking with the Fed, and this Fed in particular, is any sense of foresight. They're always backwards looking, always, you know, Mohammed El-Erian has been quite vocal on this as well in terms of being overly data dependent,
Mhm.
you know, sometimes outright ignoring the data. I mean, that's how we got inflation is transitory and money printing with 7-8% CPI. Oh, don't worry about it. This was in 2020, they actually wanted more inflation. In 21, they said it was transitory, and now in 24, and it's too high. And so we got this bifurcation here too, which is we got now central banks cutting rates, i.e. the ECB, but the Fed is not. That's typically also not what happens, because usually these guys are all on the same page. And yesterday, the Fed upped its inflation forecast, which kind of ironic given the lower than, the lower inflation prints we just got. Yep. And they upped that dot plot. So here's the problem. Higher for longer is not hurting the rich at all. It's not hurting the big mega cap tech companies who are at this point immune to all this because of all the growth stories that they have behind them. It's hurting small businesses. It's hurting regional banks. It's hurting middle class. It's hurting poor people. And this is where you get the ever widening wealth inequality again, right? Because the party for the rich keeps going. And by the way, there's $6 trillion in money market funds who are now earning nice interest on top of everything else, right? Which is kind of also somewhat stimulative in this sense.
It
but
is.
The biggest
to those with assets.
Yes, those with assets. But the biggest crime, I'm sorry to say, is what's been happening with the housing market. Because housing, as you know, is the least affordable it's ever been. An entire generation has been priced out. You and I got both kids that are out going into the wild world, and no one can afford even rents. And what can I say this on this channel? What really pisses me off is the lack of accountability by the Fed. Yesterday, Jay Powell said, housing is complicated. Really? Here's what's happened. We had 13 years of zip, right? We got all these mortgages locked into very low rates, right? That was kind of this constant stimulus and printing. Then, and following that came out of the result of the financial crisis when housing was blowing up. And they came in with QE and they bought mortgage-backed securities as a save the system rescue measure. No problem. Fair enough. Then Bernanke came out in 2010 and says, we're going to get the balance sheet back down to below 1 trillion. He said that in front of Congress. Well, we all know what happened. They kept going. Bernanke himself kept going, with QE up to $4 trillion. Then COVID hit. And for some reason, that's not been ever asked. It's never been explained. It's never been justified. The Fed spent $1.7 trillion buying mortgage-backed securities into a supply-constrained, pandemic-driven, supply-constrained housing markets, just ripping housing prices up. They did that. There was zero reason to do that. There was not a housing crisis. There was a temporary freeze because of the pandemic, but they caused that housing price inflation. And then once they realized that they screwed up, because inflation was just carpet bombing them left, right, and center, that's when they raised rates finally, and did it as fast as they did. And because of all the ZIRP money, low mortgage rates we've had all before, what basically then happened was the entire housing market supply got constrained because people sitting on low rate mortgages don't want to sell.
Right. You locked them into their existing homes because they they can't buy a new home on better terms if they sell their current one.
Right. And so, yeah, why would I give up my house, my low mortgage, and go into a higher mortgage home? Makes no sense. So they kill the supply. What happens when you kill supply? House prices stay elevated and keep going up, right? I mean, if you look at Zillow right now, I mean, this is the latest chart I have from them. Where's your house relief? Where's your home price relief? It's not there.
Yeah.
All-time highs. And so now we're in this really bizarre situation. When you look at the subcomponents of inflation, one of the biggest drivers remaining is rents, right? Because people can not buy homes, so they rent, which drives up rental prices, right?
Mm-hmm.
So in a normal market universe, if the Fed raises rates, it would soften the housing market. In this universe, because of all the policy mistakes they made before, higher rates are keeping house prices artificially inflated. So by staying higher for longer, they're exacerbating that situation. So it's completely upside down. So ironically, by them insisting to stay higher for longer, they're actually the cause of house price inflation in this environment. It's complicated, he says. Well, you guys are kind of digging your own grave here, because you want lower inflation, but you're not quite getting to your target. But because you're staying higher, you're actually prolonging the pain for those who are subject to the pain, which is, again, not the top 1%.
So there's so much on
But
this.
we're here to serve all the people, right? No,
Well, you and I are. I'm not sure about our policymakers, my friend. So there's so much on this that I've been waiting to get to this part of the conversation to dig into you, and we're beginning to get a little tight on time, but we'll just blow through things if need be. Yeah. So Powell, a couple of things. So yeah, he was asked specifically. The very last question yesterday was, "Hey, housing's become really unaffordable, and if you start cutting rates like you say you're going to do, isn't that just going to push prices up even further, and make housing even more unaffordable for those that are giving up on buying into homes right now?" Which is really interesting because yeah, we've created this Frankenstein market where low rates, ZIRP, pushed housing prices up. Then high rates have kept prices high, and presumably low rates are going to raise them even more again. But yeah, so Powell just totally evaded that question, right? He just said, well, I don't look at any one particular asset. We look at the basket, and just totally give a non-answer. At the very beginning in his prepared remarks, one of the very first things he said was, hey, I just want to say, the Fed's made really good progress on its dual mandate over the past 2 years. We've kept unemployment low. We've brought inflation down a lot. Okay, yeah, but there was like no mention to its role in creating this runaway inflation that you talked about, right? Just only talking about them playing the hero, not playing the arsenal that actually started the fire. And there's a analysis I've been mentioning recently that just came out from Trueflation, who it's another alternative way to track inflation. And they have a massive basket, millions of different products and services. And their basket calculates that the price inflation we've seen since January 2020 is almost 25%. And I know a lot of people are looking at it and saying, yeah, it feels right on, although maybe it even feels like a little bit like an understatement. And so in the past 4 years, based upon the decisions that our policymakers made, we've had a quarter of the purchasing power of our wealth just wiped away in just 4 years. And I think if people had been given the option, and this never would have happened, but if people had been given the option of, hey, pandemic hit, it's disrupting the economy, we're either going to have a recession, probably, relatively short-lived once we open the economy back up, but it's going to hurt, but we'll get through it. What do you want? Do you want that, or do you want a quarter of your wealth to go away forever? I think most people would have said, you know what, I'll take the recession, buddy, right? And actually, Neil Kashkari, the head of the Minneapolis Fed, I was just reading an article that he was interviewed in, and he was actually talking to some groups that represent workers who said the exact same thing. They said, you know what, like, screw all this inflation we got. If you had given us the chance to take a recession, we happily would have taken it. We know how to deal with that. We're used to it. The economy works in cycles. You know, we know if we lose a job that we can get reabsorbed in the economy at some point in the future. We know how to kind of survive in the interim. But to have just, our wages basically drop a quarter in value or more in just 4 years, it's like, totally existentially threatening to us. Like, we never would have wanted this. And Kashkari was like shocked at this idea, right? So I've gone in this little tirade here, but kind of to the crux of what you're saying here, Sven, is they've created this bifurcated system, both on corporations and on households, where the few who are doing well continue to get really vastly enriched. I mean, almost at an accelerating pace by the policy decisions that our policymakers are pursuing. And everybody else is falling behind, again, kind of at an accelerating rate. And I talk a lot about the importance of understanding the mean and the median, and maybe we'll take this back in a moment to your charts. But because the small coterie of beneficiaries is making so much freaking money, they're keeping the average, the mean, actually looking pretty good. So if you just look at headlines, you're like, yeah, okay, things seem to be going all right, right? But if you look at the median, the 50th percentile
Record
person,
household wealth, they call it, right? Things are
record
good.
household wealth, yeah, great, yeah, on average, yeah. But if
It
you
just
do it
means
at a median per capita perspective, not at all. That guy's really hurting. So, I guess my question for you, Sven, is like, where does this go? There's a big part of me that just, hates the injustice of this, but there's also a part of me that says you can't get away with this forever, right? At some point, your dispossessed population gets so big and so angry that it revolts in some way. Is it going to have to get to that? Like, are we going to spend the next decade or so of just the rich getting vastly richer and the rest of us just getting angrier and angrier about it? Or do either natural market forces or political forces change this?
Well, the Fed's official dual mandate is full employment and stable prices. All right, that's the official mandate. If their mandate was to create the most extreme wealth inequality in society ever, I'd give them an A+, because that's consistently what they achieve from cycle to cycle. And yes, I think it's fair to say some people would actually prefer a recession to get, like, for example, affordable housing again, right? Or some sort of cleansing. But I've talked about this before. They cannot let the system cleanse because we're at 191% market cap to GDP again. It's so historically absurd. And I hate to say it, we'll also have election cycles. And politics play a role, and this bifurcation that we see not only on the corporate side and the market side and in terms of wealth and everything else, we see it increasingly in political structures. I mean, obviously the US has an election this year. The UK has an election. Boy, there's some anger there. We just saw this in France. We saw it in Germany, right, for these European elections. And what you're seeing is the party system is fracturing ever more. And to the point where you have just fundamentally different outlooks on how to manage society or how to even perceive reality. And I just don't know how you're going to ultimately have a cohesive society working on problems together. And everybody can have different opinions on how to solve problems, but if you don't have a common reality, you can't solve this. So they're basically always forced to go back to the pivot, because what happens if you let it right size? I cannot even imagine. I mean, the global financial crisis would be a cakewalk compared to what would be coming at this point. I mean, I don't see there's a difference. I mean, frankly, I don't see there's a difference who's going to be elected in the US. I mean, you have all these social political differences on paper, but look what just happened the last 4 years. Everybody votes for kicking the can. Both parties. But at the end of the day, that's where it's at. So I hate to tell you this, I don't, unless something breaks that forces change, I think it's going to continue on this path.
All right. I mean, that's what you said about the markets. Sounds like you're saying the same thing about society and governance.
Well, who is there that would change things?
Yeah.
Who has? Have you seen a single politician go and a major candidate that actually has any sort of popular support and says, guys, I'm going to promise you pain. It's going to be horrid, but we have to do it, and this is how we're going to do it.
Right. And
And
who
by
would
the way,
elect that guy? I mean, it just we as the populace wouldn't stomach that either, sadly.
No. So it's again about either tax cuts or it's about, this asset class or that asset class, da 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 da. Keep the party going. I mean, we see it again now. I guess, this election here in the US may have some implications with regards to corporate income tax because of the tax cuts are expiring next year.
Right.
And there's some talk about taxing billionaires more. Yeah, good luck with that.
Right. You can ratchet the tax up.
That's not the
To
issue.
avoid it. Yeah.
The taxing is not the issue. The issue is the spending. The issue is the spending. And that's when no party stops on that front at all. No. And it's not like they're spending it on fabulous things in many cases.
No. And also I do worry, and this is danger of making the conversation go way, way longer, but that even on the spending side, I can see the West, the Western populace, voting populace become more and more like we just saw in Mexico, where, yeah, things are bad and not getting angry about it. And rather than elect people in there that are going to fight for change and the pain and the harsh medicine, instead I'm going to vote for the person that's just going to promise me the most handouts, right? Which exacerbates the spending problem even further.
Or worse. This is unfortunately history repeating itself, and hopefully not. But you get to points where you have a large swath of the population unhappy, miserable, left behind, and vulnerable to coming to voices saying, I'm the guy who's going to bring it all, make it better again. And makes sense. People get sucked in, but exactly how are you going to make it better again? In what form? And that's where you don't see answers. You get a lot of platitudes and promises. I just say in general, very, very divergent societies that where a lot of anger is building it's long-term not a healthy thing. And that's probably, I would argue, another reason why the party needs to keep going, because a recession would actually exacerbate a lot of that.
Well, all right. So let's actually talk about that real quick, and then I want to wrap up just by asking you a question I should have asked you earlier. But hey, given your market outlook, I know you're not a money manager per se, but what asset classes do you think make sense given your current outlook? But let's just talk about this recession for a moment. It feels like we have crossed the Rubicon where a recession is no longer part of a natural and healthy business cycle, but it's the event that shall not be named that we shall try to hold at bay forever at whatever cost. I mean, clearly that can't be true forever. And there would be a lot of healing benefits in addition to some of the potential threats to the status quo that you just mentioned. But I mean, there's a lot of froth and excess that a you know a decent recession could at least partially remove and restore, you know, a little bit more fairness and longer term resilience to markets. Um, do you think that they've now got such a fine control of the dials that they can just keep the recession at bay no matter what, or do you think eventually, you know, market forces will, at least for some period of time, escape the control of those central planners trying to control it? Because these guys aren't rocket scientists, as you've shown with the Fed's, you know, past record of predictions.
No, they're not rocket scientists. And in fact, they're just really bad at forecasting, it seems, a lot of the times. Look, I think we got two congruent factors right now that are supportive of a recession being at least currently averted. And that is, again, fiscal impulse, because you got that underlying just massive money blow in the economy that overstates everything. By the way, M2 money supply growth is positive again, go figure. And you do have a new business cycle model that has, at least for now, the appearance of legitimacy, which is AI. Now, anyone can argue what ultimately the earnings story behind that is, but the fact is the spending is real, the infrastructure spending is real. I mean, they're building entire cities of servers all over the planet, which will, you know, cause a massive spike in energy demand. I mean, that part is real, right? That's why NVIDIA has such fantastic growth story to tell. Now, is this ultimately going to hit a point where, okay, enough is enough? You guys are overdoing it, and, you know, i.e. Apple AI announcement, you know, basically they're giving it away for free. Well, what's the revenue model there? You know, don't tell me you just added $400 billion in market cap because you have a calculator app on your iPad. You know, at some point that needs to come to reality. But to the extent that
and sorry to interrupt, but yeah, just to underscore that, like, they basically announced a product that they didn't build. It's not their software. They're presumably not charging for it, and
no,
yet it added,
and they're getting it for free too. So
yeah,
it's awesome.
and it basically bolted a Tesla's worth of market value onto Apple.
Yes, in 5 weeks. Yay. No, I mean, it's unfathomable what we're seeing there in these market cap expansions. And yes, I do see all that as a potential risk. But pointing out risks can be useless until you see evidence of something actually turning. We saw that in 1999, 2000. These things can keep going to unfathomable degrees. And again, the difference here now is that these companies have great earnings. They have a great story to tell, and they have a global footprint, which is massive, massive user bases, right? i.e. Microsoft, i.e. Apple, who they can market these new services to. And we all don't know yet how these services ultimately will play in terms of productivity growth, new applications, new business models. I mean, there's all kinds of possibilities that I'm trying to get my head around as well. But if they spend it, they will come, is kind of the current attitude. So these two things are, I think, keeping things at bay for now. And don't forget, and none of us can forget this, if you think that the Fed would not flip-flop on a dime, if, for example, labor reports all of a sudden start to really veer off, do not forget they have an awesome, unbelievably awesome potential firepower to change things. Usually in the past, they've waited too long and they started doing it once things broke. I think the big lesson, which maybe Powell's desperately trying to avoid learning, is that you want to stay ahead of the game instead of chasing it when something does break and the confidence is broken. That's why I was so surprised about the press conference yesterday, because what they should have done, in my view, No one asked me, why should they? But what they should have done is not change the dot plot, not change the forecast, and just say, we'll keep evaluating data, full stop. What they've done instead, by putting up the dot plot, raising the inflation forecast, and keep talking about how strong everything is, they've, from a strategic communications perspective, have removed their own flexibility, because they're putting themselves again in a position where either they're going to be too late if something does break, or they're going to lose all credibility if they're going to have to start chasing really quickly if the data comes in back later. There was just no need to do what they did yesterday, especially with this unbelievable, stable unemployment rate for years to come. The Wall Street Journal article out about today about the Fed maybe having policy era PTSD because of the mistakes they've made in the past. And now they're kind of worried about making the next mistake. Well, this is just not a good place to be in if you're so concerned about your credibility. And I think Mohammed Al-Aaron has said this perfectly, that they're lacking a strategic framework that's forward-looking. So we're basically, got these ship captains steering the ship, once they hit an iceberg. Thanks.
Yeah.
Yeah, it's concerning. Hopefully the market will see through that and recognize that perhaps the data will be more supportive going forward on at least rate cut expectation. I mean, right now everybody's got a big back priced out. But by the way, this is just to highlight again this psychotic policy expectation game that we have with these guys, right? Because early December, Powell said, well, it's way too soon to talk about rate cuts. December, 12 days later, he said, we talked about rate cuts, and the market went with 7, 8 rate cut expectations. Now we're down to 1. I mean, it's just constant flip-flopping. I don't think it's a healthy way to manage expectations or the economy. It's unproductive.
Yeah.
And this is what you
I hate
get
to
when you
say
get
this.
50 speeches a month.
I've got to wrap this up here, but you keep bringing up all these topics I want to keep going on. So two things real quick. One is Axel Merck was just on the on this channel when the Fed comes out with its guidance and then Powell does his press conference. About an hour later, he and I get on. We've been doing this for the past couple of quarters, and record kind of our real-time reaction to it. And forever, Axel's been saying, huge shortcoming of the Fed is that it lacks a framework, and it's way too reactive, and he thinks the Fed communicates way too much. To your point, just doesn't need to. It's like, in fact, I don't think they should do these press conferences. He said he said, a couple decades ago, like the average guy in the street was hard pressed to name the Fed chairman, and the Fed hardly gave any guidance. We had to kind of figure it out in arrears. But he's like, now the Fed is just out there, basically just causing a lot more thrash than it needs to, and then, to your point, largely setting itself up for some sort of failure, either egg on its face from a reputational standpoint, or making it clear to the world that it's not omniscient because a lot of its predictions fail.
No, I mean, look, we're going to see this again in the next few weeks. I mean, we have days where we have literally 6, 7, 8 Fed speakers in a single day, constantly bombarding headlines, pushing out their opinions that no one asked for.
Right, and oftentimes they don't all fully agree. So you'll have the market's going one direction based on something Mary Daly said, and then John Williams speaks, and they're going a different direction.
Yeah, it's counterproductive. Say something when you have something meaningful and profound to say, but they're just handicapping every single data point, and you mentioned Kashkari earlier. I mean, just go back to the pandemic, you know, he was given speeches how he was opposed to any sort of rate hikes until the end of 2023. What value was that?
Right. Totally, totally
What,
not.
how did that help? Other
Well,
than it just shows they know nothing. So then don't talk.
okay. All right. So in this environment, it sounds like you're still reluctantly long,
Yep.
because you mostly deal with the indices. Sounds like you are maybe getting increasingly interested in the small caps, Russell. Um, are you at the point where you're taking a little bit off the table on the Nasdaq and the S&P, given the fact that they're been, you know, they move so much and they're hugging the top of the Bollinger Bands?
Yeah, we're out of Nasdaq at the moment. That was just too much for us, and
Okay.
out mostly out of SPY. We got a little bit left, and basically just, you know, this is, by the way, one of those really key skills for trader, which is patience. You know, we've got exposure in small caps from lower, and you know, ready to test when the next liquidity hiccup takes place, and then look at the next confluence support levels and ready to strike again. So we are long, but less so, and still have exposure to the upside. That's kind of where we're at.
Okay, great. All right. Well, like I said, Sven, I could easily keep going, but we'd make this a 3.5 hour discussion, which maybe the audience would love to hear. All right. Well, very important question for you, my friend. For folks that really enjoy your analysis and would like to follow you and your work in between now and the next time you come back on this channel, where should they go?
Well, northmantrader.com is the website. I write a daily brief where I go all the signal charts and our strategy in detail each day. And then we have a live alert feed where we kind of keep the day-to-day going, and trade alerts, and then market videos where every week or two I put out a lengthy video kind of going the voiceover on some of the charts that we've seen. Of course, my Twitter feed, X feed, Northman Trader, at Northman Trader. That's where I'm most at home.
All right. Can't recommend enough that folks follow Sven's work, especially if you've enjoyed, you know, Sven walking through his charts earlier. If you enjoyed that, then you will absolutely love his premium service. Sven, when I edit this, I will put up the URLs on the screen to your website as well as your Twitter handle. Folks, I'll also put the links down in the description below this video so you can get there with just one click. All right. Well, look, in wrapping up, if you'd like to have Sven come and join us again on the channel as soon as he sees something new in his technical analysis, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. A reminder, we're getting quite close now to our 100,000 subscriber mark. I think we're getting close to around 6,000 subscribers to go as of this recording. Really appreciate your help. If you can help us hit that mark. If you haven't subscribed yet, please do so now. It really will help us not just get the fun little plaque you get from YouTube, but it'll help YouTube tell the algo to treat these videos even more seriously going forward. All right. Oh, and then obviously, if you would like help in trying to figure out how to position for this type of future that Sven's talking about, like I said, I say all the time on this channel, unless you've got a really good track record, you've already proven as a successful DIY investor, I recommend most people here work under the guidance of a good financial advisor. If you've got a good one who can help navigate all this for you and take into account all the macro issues that Sven talked about, great, stick with them. But if you don't, or you'd like a second opinion from one who does, consider talking to one of the financial advisors that you see on this channel with me every week, who do take into account all these issues. To schedule one of those free consultations, free, no strings attached, no obligations, just go to thoughtfulmoney.com, fill out the short form there. Only takes a couple of seconds, and then the firms will reach out to schedule that free discussion with you. All right. Well, look, whatever the path is from here, Sven, open invitation to come help us track it in real time as your TA tells us, you know, what's most likely to happen next. Very much appreciate it, my friend. I look forward to having you back on the channel as soon as your TA has something that you want to share with the rest of us. Everybody else, thanks so much for watching.